we bounced. We bounced off the 140, those low yields on the 10-year. For people that don't know, when was that? 2.5 years ago you said we're going back below 2? I mean, you've been saying this for a while for a lot of, I think, demographic reasons and global reasons. But I think you said we could go to 1 and below on the 10-year. So is this a brief respite from the continuation of a downward trend in yields?
Joe, I think that is very much it. We have had bounces before. There were times when I had to explain on Twitter repeatedly that when the 10-year yield went up, I was still expecting it at that time to go below 2%. And I think the current bounce is no different. I think there is a lot of optimism based both on the trade expectations as well as for the Fed cutting interest rates. But you just now, this morning, you saw two big influences on the 10-year yield. One, you saw the ECB rate cut and the open-ended bond purchase, both of which you spoke about a few minutes ago.
Right.
And the other one, and that in turn is pulling the U.S. yields down. I think that's going to cause that to happen. The other one, all three of you, Becky and Mike, moved market. I was watching it in the green room, and as Secretary Mnuchin was speaking about the possibility of a 50-year bond, the yields went up for the 10-year and 30-year. If anything that is going to spoil my forecast, it is issuance of a 50-year bond or a 100-year bond, which I don't think the market will have an appetite for.
So I was going to ask you, with you saying that we're going to resume the downward move, whether that portends bad things for our domestic economy, but the things you're talking about are Europe, or at least global factors, except for the 50-year bond part. But that's also sort of a global phenomenon, too, because rates everywhere are bringing rates here to those levels where we could do a 50-year, right? So you're not saying our economy is ready to slow in a meaningful way that will bring the lower yields, or you are saying that?
I am saying that. So that is something I have been saying for quite a while. The difference, Joe, is that what happened with the ECB and all of your interview with Secretary Mnuchin, those are the new developments today, and they are adding on to the pressure that I talked about. To the extent the 50-year bond remains just a hope for the government and it is not a reality, I think the yields continue to go down because inflationary expectations won't pick up and real growth is slowing.
Let's bring in another tweet from the president. President Trump this morning tweeting just in the last minute or so. It is expected that China will be buying large amounts of our agricultural products. No explanation on this, no talk if there's something, a phone call or anything that's happened, or if this is just kind of laying the groundwork for the negotiations that are set to begin next month.
It may well be the latter, Becky. We have heard expectations of big agricultural purchases in the past. The hopes have not materialized, and I don't think this situation is any different. The concessions that were made yesterday on both sides, the U.S. side and Chinese side, is to alleviate pain to the respective populations. It was not meant to be a truce on the trade war. China is hurting, and U.S. farmers are hurting, and that is what it's supposed to do. This is not a resolution of the trade fight at all.
I mean, Sri, your bearish outlook on the domestic economy wouldn't seem to be requisite for lower rates because your entire move that you've forecast a year and a half ago has been with better GDP than we had prior to that, lower unemployment than we've had in many, many years, and we still dropped from where we thought we were going above 3 to where we were below 1.5 in very positive economic times. So in this, the next move, the next leg down will be accompanied by a weaker economy in your view? Or does it have to be that? Or could they continue to go down and still have a better economy here relative to the rest of the world?
Even when I first said that to you, Joe, 2 or 2.5 years ago, a weak economy was the basis of it.
It didn't happen.
Well, other than the sugar high that we got from the year-end 2017 tax cut, the growth was slowing before. It went up because of the tax cut, and we are slowing again. The question is how do you
3.5% unemployment, Sri?
look at the participation rate.
Okay.
You're looking, participation rate has not returned
Ticking
to the
up.
2007 highs.
Well, it may never with the baby boomers.
But even if you look at the 25 to 54-year-olds who are
Right.
not affected by demography, that figure hasn't gone back to the pre-Great Recession.
It's improved, though, in the last 2 years.
It has improved, yes. But 11 years after the recovery has begun, our participation
So what's
rate
our
is similar.
problem? We got all this stimulus, and are we being dragged down by the rest of the world?
Our problem is you need structural changes. You need more immigration of skilled young individuals who bring both a mouth and two hands and helping both the
That'll help with
consumption side.
GDP, yeah.
Yeah, that will help. You also need something for worker training. You need more skill creation. This is what we learned from the German experience of 2003. Instead, what we are doing is to repeat the Japanese European situation, neither of which has essentially paid off.
Germany's at 0, so why do we want to repeat what they did?
Well, that is more recently. But if you look at where they were in 2003 as the sick man of Europe, they came roaring back for all these years until the most recent
Well, it
weakness.
helps when you get your currency controlled by economies that have the multi-speed economies that aren't doing nearly as. I think I could do pretty well as Germany too if I didn't have the mark anymore.
Yeah, but then the big improvement for Germany happened at the early years of the Eurozone being created. We are talking about 2003 to 2008 that they improved. And that's just not happening yet, Joe.
Okay. All right, Sri-Kumar. So where are we going, below 1 or just to 1 on the 10-year?
I will just say 1. I'm not going to go
they're
with
not going
others looking
negative.
for a negative
Bounced
rate.
off 1.4 twice within 3.5 years apart. Some of those chart readers are saying that's a real bottom. We'll see.
Well, we'll see. I think 1.4, we are going well below 1.4%. And the reason I say that, Mike, I'm looking for the German yield, which went down sharply, or whatever you call more negative rate as going down today as a result of the ECB move. And as Joe talked about the recession signs, as they become more apparent in Germany, I think you're going to see that going down. And when you have the spread so wide between Germany and the United States, that's going to take the U.S. 10-year down.
You're new, Santoy, but Becky will tell you we don't like people that pick bottoms around here, right? Am I right?
It's true. Well,
in
that case, I'll mention that it was Rick Santelli who's been saying
all right,
that.
All right, you're going to take me seriously. All right, I was kidding around. Anyway, Sri, thank you.
Thank you.
see
Good to be back.